Good afternoon, everybody. This is Brennan, Libbey, partner at Livingstone and head of our business services group. I think we're still have some people entering the call, but we're going to get started. So thank you all for attending our call today. We were pleasantly surprised by the interest, which either speaks to your respect for Livingstone and today's speakers or empty calendars, hopefully a little of each. I think what we're going to talk about today is how for the second straight recession cycle, we've been blindsided by unique events leading to unprecedented contractions in our economy, requiring complex and difficult decisions for business owners and investors. Today, we would like to share with you what we are seeing firsthand from our clients and the market at large, as well as answer your questions. We'd like to keep our presentation to around 20 minutes with 5 to 10 minutes after for questions. If required, we'll be happy to stay on to answer questions as long as you have them. Feel free to send over your questions via the question icon on the Zoom menu, Q&A. We will share a Q&A document after the webinar as well. You can also ask your questions anonymously by checking the anonymous box under Q&A. On our call today, we have Mark Birkett, who co-leads our debt advisory practice, and Colin Campbell, who leads our efforts in IT services and HCIT and is a senior member of our business services group. I'm going to turn it over to Colin.
Thank you, Brennan. All right, so what we've done is we've pulled together transaction data over the last 3+ years. And what we've done is we put that together and tried to understand from the valuation perspective, from a deal volume perspective, what has this meant to our industry in particular that we all operate in, that we cover. So I'm going to take you through the data. I'm going to look at some of the sub-industry data. We're going to talk about what that means for valuations. And then we're going to go through specifically in the IT services space, some of the drivers of what we're seeing and what we're hearing from market participants and things that you should be thinking about for your business in particular. First thing to note, so last week was the first week in the last 15 years in which there was no merger or acquisition announced that was above $1 billion. So when we think of the M&A market, north of $1 billion is sort of that bulge bracket space, and where Livingstone tends to operate is more in that middle market space, that sub $1 billion. And what's interesting is that while the top end of the market may effectively, in this case, go to zero and go away for a short period of time, the middle market space does not. And what that means is, and the takeaway punchline ultimately is, the middle market does remain open from an M&A perspective, though it will be constrained. And we're going to talk a little bit more about that here in a little bit. So the data that we're looking at here, I pulled IT services broadly, which is where Brennan and I tend to spend most of our time focusing. And IT services, we think of it as IT consulting, healthcare IT, internet services, and data services. And for the purposes of this, I've broken healthcare IT out separately, more for visual and for understanding and comparison. So over the long term, call it 3 years plus the first quarter of this year, we've seen a general trend where deal volumes have increased. And I think this makes sense and is consistent with what we've talked about previously. There's a lot more operators in the space. There tends to be lower barriers to entry. The big driver in the IT services space from a sub-segment is IT consulting. Private equity has been a driver of more deal volume as they've gotten increasingly interested in the recurring revenue models, subscription models, being able to leverage technology to really drive greater margins. So that all impacts the financeability of the businesses and helps impact and improve their ROI. And so for that reason, I think you see more operators in the space, you see more buyers in the space. Now, what you do see though, and I'll draw your attention to the far right-hand side of the screen, is that in the last few months, we've seen a pretty meaningful decline in deal volume. So the question is that something that is systemic and indicative of something bigger, or is that really short-term and maybe more related to the pandemic? So looking at data from 2019 through April 20th of this year, and again, April in this graphic is a partial month, but I think it's still helpful to understand what the trend is looking like. And so in general, actually, all 4 subcategories have seen a slight decline in average deal volume. In fact, if you look at April of this year, internet services and data services are actually trending roughly in line with their 14-month average. Where you see the biggest decline in deal volumes is going to be IT consulting and, to a lesser degree, healthcare IT. And I think this makes sense, right? I think what we're finding and what we're hearing from both buyers and investors, as well as sellers, operators in the space, is that really everyone's focus has transitioned to less about a healthy sell side transaction and more around managing the business today and making sure they're making the right decisions for their customers and their clients and their employees. This is one thing where, when we hear from operators, the consensus seems to be, and this is specifically for the IT space, is that a lot of the ongoing work that had been engaged prior to March has continued. There's been very little cancellation of ongoing work. Now, new opportunities that were in the pipeline that were due to be signed up in March or in April have started to slide to the right. So some of the engagements that would have gotten signed up in March are now getting signed up in April. It also depends on your end market exposure. Obviously, operators that are more exposed to those hardly hit industries are seeing a pullback. But other operators, for the most part, in professional services, security, they've actually seen a bit of an uptick that has offset other pullbacks in their business, or in some instances buoyed them fairly well, so that March is coming out to be a very good month. April looks to be fairly strong as well. So it's not impacting everybody the same. And while business is getting delayed, it's not necessarily getting canceled. Now, the one thing I will caution here is that we don't know how long this will go on. We all hope this turns around rather quickly. And based on some of the volume numbers in April, we can think that there is potentially reaching a floor here that hopefully extends into May and we see it begin to recover. That being said, I think most important for operators in this space, and really even maybe more broadly than that, CFOs need to be changing the framework in which they think of managing the business. And I think what we're finding is that really prudent CFOs are beginning to look at the business almost from a restructuring officer mindset, where cash is king and they need to be thinking about what does their AR aging look like? What does their AR balances look like? What is their cash balances? And really monitoring that almost on a day-to-day basis. What we're going to see, unfortunately, is that many of our IT services customers, so the end consumer of IT services, especially depending on the industry, may not survive through this pandemic and the resulting recession. What that means is that for the channel partners, the intermediaries, those responsible for digital transformation implementation, need to be thinking about how you can support those customers and their cash needs. And that's one thing where it seems as though some of the larger upstream channel partners, the Amazons, the Microsofts, the Googles, may not necessarily yet be stepping up the same way some other channel partners have, like a Cisco, for example. We're seeing the former start spending money on advertising, highlighting their products around things like collaboration and security. And no doubt, I believe there will be a greater demand for cloud coming out of the recession and the effects of the pandemic. But Cisco has gone one step farther, and I think has really recognized this as an opportunity to establish goodwill with their end customers and ingrain their products and their services with the ultimate consumer. And that's where they've created a deferral program, a payment deferral program, where effectively you can buy Cisco products and services today and not really pay for it until some date down into 2021. Meanwhile, the integrators and the resellers that are dealing with Cisco products, Cisco is still paying them today as though that invoice had gone through and the payments are done. So we haven't yet seen, Amazons and the Googles and Microsoft really step up in that sort of fashion yet. But that's something that they're going to want to think about, is how do you manage that cash flow and use your balance sheet? And those companies all have very strong balance sheets to help support your channel partners, support the ecosystem, support the end customers. And I think it could be a very good investment for them in the near term. Now, all of this being said, I think the next question is, how does this ultimately impact valuations? And I think, again, over the recent 3 years, we do see that on average, valuations are going up. Now here I have consolidated all of those various subcategories of IT services into one, because there are a limited number of data points that we can actually reference here. And that so much so in the recent period, you see that we don't really even have great data to make any sort of meaningful conclusions up through the end of Q1 and into the beginning parts of Q2. So this data in particular, while helpful, I think is something that we're going to have to continue to track. And I think it'll be interesting to come back and revisit this at, partway through May, towards the end of May and into June, and start seeing what do the data points imply. But I think, in general, the key takeaways here are, one, the middle market remains open, though volumes and valuations are down. New projects are still coming on board, though they are getting pushed to the right. And operators need to be focused on the cash flow in their clients. And I think, the decisions being made today in the short term will have much longer term effects, so much so that ultimately companies today that can demonstrate stability or even a marginal contraction will be very well positioned coming out of this for whatever their strategy may involve, whether that be a sale or a refinancing. But the decisions being made today are going to have much longer term impacts. A lot of that has to do with how they manage their business and, of course, the capital markets. And so I think that becomes the segue to a colleague of mine. So Mark Birkett, co-head of our debt practice, is going to take over from here and share his insights on what he's seeing in the capital markets. Mark?
Great. Thanks, Colin. Good afternoon, everyone. I'm going to spend a few minutes just discussing the current state of the private debt market. Though before jumping to the current environment, I wanted to quickly revisit where we had been before the impact of COVID-19. I think as many on the phone are probably aware, the debt markets, particularly the private debt markets, have been booming for the last number of years. Competition among lenders has been quite extreme and has driven terms to generally be fairly borrower-friendly leading up to the COVID-19 situation we're currently in. However, in the last two quarters, really the end of 19 and the first quarter of 20, we had begun to see lenders focus a bit more on higher quality borrowers. We were seeing this manifest itself in the broadly syndicated market through a handful of different metrics that are tracked. And then also in our own practice here at Livingstone, the debt advisory practice at Livingstone, where we're more focused on the middle market in conversations with lenders, whether it be just general marketing calls or specifically in our financing processes that we were running. Lenders who historically may have been on the more aggressive end of the spectrum communicating to us that they had a belief institutionally that we were coming to the end of this decade-long economic expansion, and internally we're beginning to shift to a slightly more conservative perspective. And so debt markets were generally quite healthy, but there had certainly been some conservatism beginning to seep into the market. And so fast forward to where we sit today, I think certainly nobody could have anticipated the suddenness of the challenges that are being faced by so many companies. And understandably, this has caused lenders to scramble with their primary focus being their portfolio companies and preservation of capital that had already been deployed. And so for the first 2 to 3 weeks of the shutdown, lenders were essentially 100% focused on the liquidity of their existing borrowers in their portfolio. It was essentially all hands on deck for portfolio matters, and that included individuals who were on the origination side, traditionally not dealing with portfolio. It was truly all hands on deck. Borrowers, including those that were flush with cash, fully drew down revolvers and dealing with either existing issues or anticipated issues. There was a high degree of amendment activity, lenders and borrowers finding agreement on changes to amortization, excess cash flow sweeps, incremental debt baskets, et cetera. And I think if any of the management teams on the phone are currently going through that situation with their lenders, one theme we heard repeatedly from lenders was that the companies and the teams that were more transparent with their lenders about plans, issues through to the customer base, those companies generally were better able to get the accommodations they were looking for from their lenders. And so transparency, surprisingly, was, not surprisingly, was certainly beneficial. And then even more recently, I think we've all seen the news reports of all the various government loan programs that are out there. And similarly, if management teams have been considering pursuing those and haven't done so, we would certainly encourage people to get started on that. Again, the demand for those has been quite high, and hopefully the PPP will be extended here shortly if it hasn't already in the last couple of hours. And so as we sit here at the end of April, or almost the end of April, much of what lenders can do has really been done in terms of supporting their portfolio companies. They've transitioned from a highly active mode, and maybe not 100%, but getting close to transitioning to a period where they're essentially waiting to see what happens as their management teams that they're working with execute on the plans that were put in place in the first couple of weeks of the shutdown. And so with a little more time on their hands, and certainly with the originators, I think, being relieved of their duties on the portfolio side, there's been a heavy outreach to groups like us, and sponsors are probably seeing it as well, with lenders in search of new deal flow. And the volume of calls from originators at private debt firms has been quite high over the last couple of weeks. And the message that these guys are trying to communicate to us is pretty simple. They want us to know that they are, quote unquote, open for business. And while we've heard of a handful of deals getting done in recent weeks, those have been with businesses that were either not impacted by the shutdown or those that are in fact benefiting from the shutdown. I think at the opposite end of the spectrum, we've experienced firsthand in some of our processes, and also heard through the grapevine, many more situations of lenders pulling term sheets from active processes. And so while lenders are suggesting to us that they are open for business, in our opinion, what they really mean is they're open to reviewing new opportunities. They're willing to participate in virtual meetings, essentially do some upfront work in an effort to be ready to proceed once this period of uncertainty starts to clear. And so despite all the uncertainty, what's driving the push for new deals? And in some part, it may just be pure boredom of originators, but more likely it's the pressure to deploy capital, which for originations groups across the private debt world is a perpetual pressure. It's been there for decades, and it'll continue to be there. Industry estimates suggest that private credit funds are sitting on about $250 billion of dry powder. And so not only is the clock ticking on these funds to deploy capital, the clock's also ticking on the calendar year from a compensation perspective. And I think given where we sit in 2020, originators who are being compensated based on funds deployed, I think, are certainly hoping that there's an opportunity to salvage 2020 and not just write it off, at least not quite yet. And so as a result, there continues to be a very strong desire, or at least communicated strong desire, to deploy capital. Unfortunately, right now, there's just nowhere to deploy it. And so the question is, what is it going to take for us to get to the point where new deal flow actually picks up? In my opinion, you can really distill it down to essentially financial projections. Management teams need to be able to present to lenders a set of credible or believable financial projections. I think we're all familiar with what projections looked like in the quote unquote old environment. You'd have a growth case, a base case, downside case, maybe the ability to do some sensitivity around revenue or volume. Going forward, though, and I think we will certainly in our processes guide management teams to this, we expect lenders are going to require some enhancements to those projections. Things like proof of stabilization of financial metrics and revenues, financial metrics like revenues or margins, operating metrics like renewal rates or backlog. I think we're going to need to be able to demonstrate sector and geographic specific dynamics. As Colin mentioned, this shutdown is not impacting everybody equally. And lenders are going to want to understand how you are impacted, and also how your customers are being impacted. Another thing that we want to make sure we're able to model in is going to be the impact of any subsequent shutdowns that may happen, whether it's in the fall or sometime in early 2021. Hopefully those don't come, but in case they do, lenders are certainly going to want to understand how we're going to manage through that. And one that we think is probably a little bit under the surface and maybe not on anybody's radar screen yet is the ability to finance working capital growth in the face of fully drawn revolvers and payables that have been stretched. And I would say to any CFOs on the phone, I would recommend you, as you sit here today, to forecast what growth looks like from a liquidity perspective. Do you have the capital available to make those investments to support rapid growth if it were to come? Obviously, growth is a great thing, but if you can't afford to finance it some way, it could be problematic. And so ultimately, for those businesses that are able to credibly communicate their entire COVID-19 story, we believe there's going to be significant interest in your business from lenders. Many companies are going to be damaged coming out of this, and so the volume of what I would refer to as a good credit is going to shrink, and that's going to really further increase the demand from lenders for those types of businesses. And you may not even see, if you fall into that category of a good credit, you may not see really any deterioration in terms. Businesses that fall outside of that good credit category are likely going to need to reach out to a more broad universe of lenders to find the right financing partner. And so, as we sit here today, one question we frequently get is, what are terms going to look like once we sort of shift out of this current period of stagnation? And because there's been so little deal flow in the middle market, we can't point to any specific data points. But in conversations with a broad range of lenders in terms of how they're thinking about eventually getting back to work, we have a handful of pieces of feedback that we're comfortable sharing. Lenders have guided us, generally speaking, to think total leverage on deals is going to come down somewhere between a half and a full turn. Pricing on senior debt is going to increase somewhere between 50 and 100 basis points. Pricing on junior capital loans or unitranche loans likely to increase between 100 and 200 basis points. And certainly reasonable to expect that covenants and some other terms and credit agreements are going to become more lender friendly. And so while the market's essentially shut down today, once this period of uncertainty begins to lift, we fully expect the private debt market will be there to support companies, though it may take a little more work on management teams' end and a little more time to find that right financing partner. And so with that, I'll turn it over to Brennan to discuss what he's seeing in the current private equity landscape.
Great, thanks, Mark. So as you can imagine, we've had what I would say is a record number of calls with our sponsor clients over the last 30 to 45 days. And just want to share with everyone here kind of what we're hearing and how that may impact you. Overall, sponsor fundraising has slowed, but there's still many in process. Clear Lake recently closed a $7 billion fund. Francisco's in the market for a $6 billion fund. Silver Lake's in the market with a $17 billion fund. What you'll hear in all those names is that they're all massive funds. They're multi-strategy. They can go into the distress market. They can do loan to own. They have fund sizes up and down the value spectrum. So they really have the ability to pivot into any and all situations. And obviously, pension funds, et cetera, are comfortable fundraising into those vehicles. I think on the smaller fund side, which is more applicable to certainly our end markets, I'd say it's somewhat quieter right now. And a lot of these folks are just going to wait out the current crisis and not really go to market right now. In our conversation with sponsors, all have maintained, similar to the debt side, as Mark mentioned, they are open for business with respect to new deals, but they are keeping very busy in triage mode with their existing portfolios. Depending on portfolio sizes, a lot of the middle market to lower middle market sponsors are undoubtedly going to have multiple assets that are in distress or not far from distress in this market. What does this mean for a business owner that's thinking about an exit to private equity in the next 12 months or so? Valuations are very likely going to be lower in the near term. Sponsors are very often probably going to look for structure to protect their downside in the form of either preferred equity or some sort of liquidation preferences, terms, and protections around their equity investment. And the due diligence is very likely going to include additional layers of analysis around performance through the crisis. As Mark mentioned, and he used the term liquidity, that's a very prevalent term being thrown around all over in private equity right now, is the key to across sponsor portfolios in the market at large. If you look at the sponsors, nearly every revolving credit facility has been drawn, regardless of whether or not the portfolio company needs it. Furthermore, most are in the process of pushing out interest and principal payments, as well as rent and professional fees. I think what owner-operators can take from this is that they should be managing their business exactly the same way, with to the extent you have excess liquidity available to you in the form of lines or debt, you should pull those, in almost all cases, you should pull it down just to have it. And then I think wherever you can, in terms of pushing out payments and managing your payables, you should be doing that very aggressively. For sellers to private equity in the near term, cost of capital is going to be higher. And the result is going to be, and I think also furthermore, the bar for add-ons and platforms is higher. So, again, it's going to be more difficult, and probably valuations will take a hit in the near term here to the extent transactions occur. Overall in the market, healthy deal flow is effectively down to zero. So looking across the broad market, we estimate 100% of deals at the IOI stage are basically on hold, or nearly 100%, and 70% of deals at the LOI stage are on hold. Internally at Livingstone, we have put all of our healthy deals on hold, but we are anticipating kicking off several deals over the next 30 to 60 days. These are typically businesses that certainly aren't dramatically impacted by COVID, and oftentimes are really the impact is almost negligible. So, our overall recommendation is, unless a seller is in distress or has preemptive interest in a valuation that you're willing to transact at, it makes sense to wait this market out. The good news here is that sponsors still have over $2.5 trillion of dry powder, so the pressure to deploy capital is going to remain. But risk will also need to be managed through various alternatives. And what we're hearing from our sponsor friends is that structure, more performance-based consideration are likely to be part of this package. We do believe the fundamentals for a healthy sell-side market will return, but likely percolate through various industries and companies at different rates. We do believe that a lot of the sectors we've talked about today, whether it's IT services, HCIT, or more broadly business services and tech-enabled services, we do think they'll be in a strong position to be one of the leaders out of this downturn. So with that, we're ready for questions, and I'd like to thank everyone for joining us.
So Brennan, we had a number of questions come in, and I think they're all good ones. I'll start with them in no particular order. So the first question is, are you expecting COVID EBITDA adjustments to become prevalent? And I think I'll take the first attempt at this one. The short answer is yes. I think it really depends on the business. It depends on the end market mix. And I think it depends on how the industry appears coming out of this. So you won't necessarily see adjustments that revert back to smoothing out March, April, May, as though there were no pandemic. I think coming out of this, and I hate to use the term, but the new normal won't necessarily be what we saw in Q4 of last year. It'll be something different. And I think there'll have to be some way of modeling that in. I think all of our financial advisors are really trying to understand this in real time. And some of it's going to be a learning experience as we go through it and try to really understand what those adjustments look like and what everyone can get comfortable with. So the degree to which there will be adjustments is still to be determined, but certainly there will have to be something coming out of this. The next one, I will take this one also. What are steps businesses can take to immediately survive this? And I think I go back to Mark's comments and some of my notes, which is really it's cash is king. I think you have to be able to manage your cash balances and your cash flow. And I think the balance there is, if you're dealing with customers that are on the brink of not surviving and they need help, if you can extend your receivables for them, great, but you can't do so at your own expense. And I think that's to the extent then you can extend your own payables and create a little extra buffer for yourself. I think that's going to be important. Another question we had, are there any industry lenders, any industries lenders will be more or less willing to finance transactions in the immediate future? And then to that one, Mark, I will defer to you.
Yeah, thanks, Colin. I think I use the category of good credits, and certainly I think the businesses that were defined as good credits even before all this took effect are going to continue to be the ones that probably are falling into more favor. Things, SaaS models where you have strong recurring revenues with high renewal rates. Some of the businesses we've seen get done recently are those that are, I say recently in this current environment, are those that are supporting, call it the new economy, logistics, things that are dealing with logistics, or really just getting away from the retail world and moving more to the on-demand world. I think businesses that support that, where there's, even in the face of everything that's going on, or maybe despite everything that's going on, the opportunity for growth. businesses with simple supply chains. I think one thing we've heard quite consistently out of conversations with whether it's lenders or CFOs is that even if you're participating in a complicated supply chain, you may be ready to go, your customer may be ready to go, but one of your customers' other suppliers may not exist today or may have some other type of distress. And so if you're producing a product or providing a service into a supply chain that is disrupted by just one or two critical suppliers, is that going to impact you? And so I think things that are simple supply chains are going to be at least attractive in the near term. I think federal. I'll conclude quickly, but I think federal spending, if you're doing some type of government work that's going into the federal government, I think that will continue to be strong. So on the converse, I think there's some concern around state budgets and what will happen to state budgets coming out of this. There's been a lot of discussion of how much lost revenue there has been and just the toll that this is taking on states. And so if you're contracting with state governments, is there going to be as much budgetary support for whatever program you are supporting in the face of all that's going on? So again, I think it's going to be the things that were good before are certainly going to be good now. And I think that although the window is going to get a little smaller.
Thank you, Mark. So the next question, and Brennan, I think this one's probably best suited for you, had to do with private equity and their appetite for doing acquisitions if they've recently made investments.
Sure. This is a good question. Yeah, I think obviously a lot of these funds are very big funds. So they're going to have the flexibility to do all sorts of transactions kind of regardless of the economy. So, you just saw a big investment like KKR, and I think it was US Foods, which is really at the forefront of some of the disruption in this market. So I think you're going to see these guys pivot into areas that have, which they view are, opportunities to make a lot of money. I think, when you think about regular way sell side transactions, there's still, as I said in my closing remarks, there's still a lot of pressure to put money to work here. But what I've seen in the past, particularly out of the middle market, is a lot of these guys just will still be very cautious. They won't be willing to get out in front of things and take big risks. So I think, depending on how heavily your business is impacted by the COVID events and what, the kind of lasting impacts may be if there's any systemic changes to the markets you operate in or your end markets or your customers, I think you're going to see a lot of hesitancy to do new deals, especially in the middle market to lower middle market in the near term.
Yeah. Okay. Thank you, Brennan. The next one actually comes from overseas, and the question is for companies, and I think this really applies even domestically, but for companies that are actively looking to make investments, how it's the best way to connect and find companies that are maybe a little damaged, as Mark put it, that are open to M&A opportunities. And I think one of the best ways to do that, hands down, I think, is to reach out to firms like a Livingstone, where we have deep industry expertise. We have a team that's focused on helping companies that need a little bit more assistance than just a traditional, sell-side M&A advisor could provide. And I think that's where we've got a fairly long track record of being able to provide those types of services. And our senior bankers are all very active in their markets. So we're having these ongoing conversations. We see opportunities maybe before they become more broadly publicized. And I think being plugged into an advisor to a firm like a Livingstone, I think would be very, very helpful if that's something that you're looking to pursue. Another question that came up is, it seems that there will be work moving back to the US from overseas. And do you expect that international companies will have greater interest in having an existing or expanded presence in the US? So this is a very good question. I think we're actually seeing this play out in real time, and it's a debate that we've been having internally ourselves. So what this is doing is creating pressure on infrastructure. And can companies continue to operate at efficiently and at capacity when bandwidth and networks are being stressed to their limits? And I think what we're finding is that in more developed countries like the US, there is probably better infrastructure, and it means it's more capable of handling the ups and downs. And I think there'll be less downtime, and that all ultimately results in less impact to top line, greater customer retention, and so forth. So the short answer is that yes, I think this is going to be cause for international buyers to take a much sharper look at having a presence in their domestic markets and making sure that they've got the right investments in the infrastructure and in the people to ensure that they can manage through whatever the disturbances may be. Hopefully not this severe, but certainly this, I think, puts a highlight on there.
And Colin, I would just add that as it relates to specifically IT services, where you've seen a huge move into the offshoring, whether it's India, obviously at the beginning, China, as well as Eastern Europe, a lot of those countries, I think India in particular, they're not set up for remote workers. They are, if you go there and visit, which I've done many times, there are massive campuses where everyone is housed and is working, and to the extent they're working remote at the company rather than from home. Whereas in the US, it's much more prevalent that people work from home. So the impacts of this, I think, are going to spook a lot of people in having big exposure to the offshore guys and how that might impact their delivery capabilities.
Yeah, no, that's a good point. And especially as it relates to healthcare, where you're dealing with very sensitive information that's highly regulated and there's a lot of security precautions that have to be in place, it creates a greater need for a very robust and secure network and infrastructure. I think that's a very good point. Well, with that, Brennan, I'll hand it back to you. I know we're reaching the end of our time, but I think those were all very good questions, and hopefully we did our part to answer. And of course, if there's any additional questions that come up, please don't hesitate to reach out to any of us. But Brennan, I'll hand it back to you.
Well, again, thanks everybody for joining us for this webinar today. We will be following up with the recording and a copy of all the questions and answers that were provided here. And as Colin mentioned, in the meantime, if you have any questions or would like to have a conversation, feel free to reach out to us. Thank you very much.